Okay, so here we go. Option trading strategies. Let's start with the very basics, long call, long put. Remember what a long call means. I have a positive expectation on a positive instrument. I am bullish. I think the underlying will increase. What you're looking at, it's the stock AMD, Advanced Micro Devices. The trend is upgoing, no doubt. Short term, sideways range, maybe the price is going to increase again, and who knows, it could break the previous relative maximum. So assume that you have a bullish expectation on the stock AMD. What can you do? As we know, the farther you put the strike, the lower will be the premium you pay, but the lower will also be at the same time the probability to reach the target, cross the target, reach the break-even, cross the break-even, and finally get into the profitable range. So what do? Do you pick farther strikes so to save money, so to reduce the premium you pay, or would you pick a closer one, pay more, but having a higher probability to reach the target and gain money? In the end, if you have a bullish expectation and your idea is to purchase a call, the most reasonable choice is pay attention to purchase an in-the-money one. Let's see why. Now the stock is around $39 at the closing of yesterday. In the pre-market, it's going up, so the prices, the chain is not working because the market is closed now. So prices are referred to yesterday's close, around $39, 38.90 to be precise. Okay, here on the bottom of the chart, you can see high, low, and close. 38.9 the close. This is Interactive Brokers chart trader workstation, TWS. Choices. If you have bullish expectations, either you could purchase on a maturity, let's say December the 20th. Okay, here we have the strikes sorted top to bottom. I prefer it this way. You can just change the sorting by clicking on the header of the column. I prefer it top to bottom because it's more coherent with the chart. So I know if I am looking for a put with the lowest strike price, I have to scroll down the chart, the chain, as I would do on the chart. So this way is much more coherent with the chart. So let's look at calls. Let's pick all the strikes within 2 standard deviations. This leads up to $48 within the December the 20th expiration date. Okay, so what if we pick the call 42? It could be current with the expectation of a breakout of the previous relative maximum, which is, let's see, 41.75. So 41.79, sorry, on November the 19th. So purchase a call 42 could be coherent with the expectation of a breakout of the previous maximum, and it would be cheap for sure. Let's see. This is a bug in the platform. It happens when you want to see too many options when the market is closed. Let's see if I can make it this way. No. Okay, so let's see if I can make the prices appear somehow. Let me reduce the number of strike prices just to the one we are looking for, 42. No, it doesn't work. It doesn't want to show me the prices, so let me use another platform. Doesn't matter which platform is this. I don't want to speak of this platform. I just want you to see the prices. So this is the chain of the stock AMD, last closing price on December the 4th, 39.69. Why is not the same? we found here, oh yeah, I made a mistake. This is the last available day, 39.69 closing price, and now it's 39.96 in pre-market, but all the prices in the chains, if the chains are end of day, are referred to this closing price, 39.69. So once again, 39.69 the closing price. Implied volatility, 42.5%. The chain is marked to yesterday's closed price, December the 4th, 2019. Expiration date, the 20th of December. Let's wait for the chain to load. Here we go. So we were looking for the call 42. Here I cannot show the strikes, doesn't matter. 42, it's here, 0.56, 0.57, okay, bid ask. So if I want to purchase this right away, I will have to hit the best ask and buy for 57 57 cents of dollars per share. The lot is fixed, 100 shares, so I'm gonna pay $57. And given the fact that the premium is 0.57 per share, my break-even point would be $42.57. Okay, we can use a tool like this, the one I created, create new strategy on Stocks USA. The instrument is a call, sign is long, strike is 42, the price is 0.57, the quantity is 1. And that's it. So close your strategy. What gets out is this payoff. What we have is that we're going to lose $57 up to the strike, $42. And then from 42 and on, we will start first recovering the premium paid. Then in 42.57, we will have the break even, and then going up, the more the stock goes up, the higher will be the profit we will get. Okay, so far that's it. Now the question arises, is it better to purchase the $42 in front of the expectation of a price increasing and maybe crossing and breaking out the previous maximum? Because maybe the stock price increases, but not so much. Maybe it goes to 41, not to 42 and something. So what else could we do? We could purchase, let's say, the call 40, the at the money one, more or less, the near the money, in refer to yesterday's close, 39.69. The call 40 is slightly out of the money. Let's call it near the money. What could be the price? The price could be 125, 127. So let's say we hit the best ask and we pay 127. So what? Let's overlay strategy, overlay payoff. The instrument is still a stock. The instrument is a call. The sign is long. The strike is 40 this time. The price is 127. The quantity is 1. Close your strategy. And here we have the two payoffs compared. Of course, this is a misrepresentation due to the fact that the macro is programmed to provide the payoffs every maybe $0.50 or something like that. The payoff will be a straight line up to the strike price, and only then it would become an increasing 45 degrees line. The two strategies compared, if you take the call 42, you will risk to lose less, just $57 instead of 127, but you will reach the parity much farther in 42.57 instead of 41.27. And then the profit will be higher with the at the money call in respect with the out of the money one. Okay, given the same spot price at maturity, the gain is higher with the at the money call instead of what happens with the out of the money one. What else could we do? We could spend a little more, even a little more, in order to achieve what goal? The first goal is to pay less the value of time, because let's do some reasoning. For the call 42, the premium 0.57 is all time value. It's something that if you're wrong about your expectations, you will lose totally. The same applies with the call 40, but the offset, the quid pro quo, is that you will reach again sooner than what happens with the call 42. So what can you expect from a call 38? Just to say, you will pay more, no doubt, but you will reach again much closer. And then if you're right about your expectation, the gain will be higher. So let's see it. The call 38, just to say, is 244 ask, 241 bid. Maybe this time you can buy it for 243 midpoint plus something in the direction of the best ask. Maybe you get executed for 243, but let's take 244 just to be sure that the price is the right one. So let's overlay another strategy. Overlay payoff, the call is still long, but the strike is 38, the premium is 244. What happens now? Here we go. Higher risk, of course, if you make a mistake. The closer the break even, the higher the reward if you're right about your expectation. Even if, just assume that the stock reaches 42 but doesn't cross it, with the 42 you're going to lose all the money invested. With the with the call strike 40, you will earn something. With the call 38, you will earn something more. So what? You purchase the 38 because it's better if you're right about your expectations? Yes. But what if you're wrong? What if you're wrong? You have to take some countermeasures. And in this case, the only countermeasure you can take is decide a stop loss. So, for instance, what could you do? Let's assume that you expect that the price will go up, but when can you say you were wrong? Perhaps when it breaks down the previous relative minimum, 37.15. What can we expect from the call 38 in the moment that the price reaches 37, just to say? Being all other things equal, the call 38, if the underlying is 37 now, is in the same situation as it is now the call 39 and 50, more or less. The call that is $1 out of the money in respect with yesterday's closed. Let's go through this again. Being all other things equal, should the price of the stock fall to 37, the call 38 I am purchasing would be out of the money $1. So being all other things equal, what could it be more or less the price of that call? It would be more or less the same price quoted now by the call that now is out of the money $1. And being the spot 39.69, the call out of the money $1 would be the $40.50, more or less. So let's go. What price has it? 1.04, 1.05. So in that moment, you would be selling it. You purchase it for 244. You would be selling to get out, to take the stop loss. So you would be selling it for more or less 1.04. So you would lose $140. But if you're right about your expectation that the price will reach at least, let's say, $42, what could you get? But if you're right about your expectations and the price at maturity reaches at least $42, which means that with the call 42, you would lose all the money paid to purchase the option. With the call 38, your break-even would be 40.44. So for $42 per share at maturity, you would gain 1.56 per share. in front of the risk of losing, let's say, 1.40, applying a stop loss should the price of the underlying go down to 37. Okay, similar reasonings could apply in purchasing puts in front of the expectation of a price drop. The difference is that given the same distance between the spot price today and a call or a put, same distance, what you can expect most of the time is that the price of the put is higher. So the break-even will be farther to the downside, of course. This is not a general rule. It's not always like this, but most of the time, put options have higher implied volatilities than call options. So the prices are higher and the break-evens for options buyers are farther from the current value of the underlying.